Ladies and gentlemen, it's my great pleasure having my dear old friend Alasdair Macleod here as a guest, as an interview guest for a special about the topic of stagflation. Alasdair, thanks for taking the time.
Ronnie, it's very nice to see you again and speak.
Absolutely. Many topics to talk about. Mark and I, we prepared quite a lot of questions. Probably if we would all ask, if we would ask all the questions, it would take a couple of hours, but we will focus on the topic of stagflation and then perhaps also talk about the de-dollarization, how to get out of this mess that we're in. I think it's going to be a very exciting conversation. Alasdair, we know each other for quite a lot of years now. We just talked about our last personal meeting in Vienna at a Austrian economics conference. I gave you a copy of The World of Yesterday by Stefan Zweig. You read it, and I think you liked it a lot. And I think there are many similarities from the 1920s compared to the current situation. But I would like to briefly introduce you with your biography. So Alasdair Macleod, that's
Macleod.
Macleod.
That's it.
You're head of research at Goldmoney. Alasdair is a celebrated stockbroker who has been a member of the London Stock Exchange for over 4 decades. He's an expert in equity and bond markets, fund management, corporate finance, and investment strategy. Alasdair will join us today to discuss stagflation, a topic that he has written quite a lot about, and also de-dollarization and the economic fallout from the Russia-Ukraine crisis. So Alasdair, thanks again for taking the time. We would like to talk with the official definition of the topic of stagflation. So I don't know if there's a right or wrong definition, but I had a look at the definition by Investopedia, and it says stagflation is characterized by slow economic growth and relatively high unemployment or economic stagnation, which is at the same time accompanied by rising prices. Stagflation can be alternatively defined as a period of inflation combined with a decline in the gross domestic product. Now, I know that your uncle, Ian Macleod, he was the Shadow Chancellor in 1965, I think.
Yeah. Yeah.
And he basically coined the term stagflation, but he had a slightly different interpretation, or I think the context was a different one. So in what context did your uncle first use this term of stagflation, and how did he define stagflation?
Well, he invented the term basically to describe the economic situation at that time. And it was a mixture of falling productivity on the one side and rising wage inflation on the other side. So that was the original context in which stagflation was defined. But since then, people have taken it into the more broader sense of describing a situation, as you rightly sort of indicated from the Investopedia definition, that if you have an economy which is not doing terribly well, and you have rising prices at the same time, it's a combination of stagnation and inflation, so it's stagflation. Now, I think that the modern interpretation shows an ignorance of economics, because the Keynesians in effect are saying that the only driver of prices is demand, consumer demand. And therefore, to have a situation where you have a lack of economic growth or a recession and rising prices is completely impossible. So we'll have to call this stagflation. In other words, they see it as something which is essentially temporary. But your grandfather's history would I don't know whether you ever discussed this with your parents' parents about what happened in Austria in 1921-22, when you had a collapse in the Austrian shilling, and that or was it the crown? I think it was the crown at that time. Yeah, and that was inflation, as it really is now. The idea that the Austrian economy somehow was booming while this was going on was a complete nonsense. But on the Keynesian analysis, you cannot have a situation where you've got inflation, in other words, rising prices, and a collapsing economy. So how do they explain that? I mean, it seems to me that one way or another, we are into the sort of crisis which is probably not best described as stagflation, except in the temporary sense. I mean, at the moment, what we see is the dilemma of a global economy which is slowing in its growth, or at least the big locomotive, China, is certainly slowing big time. And all the other economies are slowing as well. Yet at the same time, we have rising prices. So stagflation, if you like, in the modern sense, actually does describe the current situation. But I think that's temporary. And I'm sure as this interview comes out, we will address the issues as to why stagflation is temporary. And actually what we should be thinking in terms of is the collapse of the purchasing power of paper currencies and what is actually driving that.
I think that's a great introduction. So when it comes to the term stagflation, as you already described in the modern interpretation, we obviously had this big example of the 1970s in the US, and it's often referred to as the only example of stagflation. I think there are other examples, but let's just perhaps talk about that one for a while. So in that case, it was temporary as well, right? So at the end of the day, I guess in the beginning of the 80s, the US was able to get out of this kind of environment. How would you describe this? How was this able to happen? And do you think this could be happening again this time around?
I think actually gets to the center of the issue. I mean, at the end of the 70s decade, Paul Volcker jacked up interest rates to unprecedented levels. I mean, Fed funds rate went to close to 20%, which meant the prime rates, which were a margin over that, was something like 20.5%. Now, that, if you like, had one specific purpose, and that was to kill the incipient inflation from turning into hyperinflation. If they had not done that, then there would have been the destruction of the dollar, because remember, it went off the gold standard, or what was left of the gold standard, at the beginning of the decade. So that was a necessary action. Now imagine the situation today, Mark. If they raise interest rates even to 5%, let alone 20%, the industries which are stuffed full of malinvestments are going to come unstuck, which means what? It means that the banks will have to be rescued, because the collateral, not only will financial collateral values be collapsing, but loans to industry and all the rest of it will start coming unstuck, so that the central bank will have to rescue the banks to rescue the economy. So that, we're talking about 5%, not 20%. And think of what 5% interest rates does to government finances. That again, I mean, going back into the 70s and 80s, we didn't have these huge, great budget deficits to finance. We had budget deficits, yeah, but I mean, they tend to be more cyclical rather than permanent. Now, not only are they permanent, but they are unimaginably large. And you have governments, I mean, not just in America, but you have governments all over the place who seem to think that the money tree is there just to be plucked. And, they can borrow. They think they're borrowing actually with impunity to deal with their existing problems. But the problem is that, the other side of inflation is debt. So just to look at debt is actually looking at the wrong thing. You should be looking at the amount of money and credit in circulation, currency and credit in circulation, because real money, which is gold, doesn't circulate at all in this current environment. You've got to be looking at that and thinking, what happens when the situation destabilizes? And I think, coming back to your basic question, I just cannot see how today anyone either has the mandate or the will to introduce an interest rate policy which is really designed to kill inflation in the way Volker did. I mean, the other thing, Mark, is that people, I don't think, understand the role of interest rates. The role of interest rates is to compensate depositors for the loss of their money, which is temporary while they lend it to someone else, and not only that, but the loss of purchasing power that they would expect that money to suffer before they get it back. That is the role of interest rates. It is not a cost of money, except obviously to the borrowers.
I just got this book that I'm currently reading, Keeping at It by Volker. It's a good read, and he emphasizes the topic of trust and the trust in the US dollar, why people trust in gold. So it's I found it pretty fascinating that Jay Powell, in a recent hearing, he was referring to Paul Volcker as being one of the greatest servants in the history of the United States. Now, I think he tried to sound like a mini Paul Volcker, obviously, but I think we all know that, as you rightly said, it's impossible to go back to those interest rate levels. However, still, for some reason, most market participants really think that now we are seeing the big turnaround in interest rates. 7 to 9 hikes in the next couple of months. I think we both agree that's pretty much impossible within this monetary system and at this stage of the, let's say, financialization of our economies. But let us briefly go back, Alasdair, to the 1970s. From your point of view, what are the major similarities and also the major differences between the economy today and the economy of the 1970s? And do you think the situation at the moment is more or less serious than back in the 70s?
Well, there are obviously huge differences between the economy now and in the 1970s. And I think one thing that I would really point out is the fact that today everything is, I mean, they say, it's a globalized economy. We're all tied into exactly the same policies. It was less so in the 70s. So you could have a situation, let us say, where one economy was having trouble, but there were other economies that were all right, and somehow or other, arbitrage, if you like, came to the rescue of some of the economies that weren't performing too well. Now we're all going in exactly the same direction, and this globalization, I mean, people talk about globalization in terms of supply chains and, the disruption that all that causes. But the one thing they don't look at is the globalization of money, because that is or currencies more accurately, because that is actually the problem. Everyone is tied into exactly the same interest rate policies, ways of managing their economy in terms of trying to suppress interest rates as much as possible, keep the cost of government borrowing down, and sort of go for a 2% interest rate inflation target, while at the same time fostering maximum employment. I mean, we're all on the same crazy spreadsheet. And that, I think, is the big fundamental difference, Ronnie, between then and now.
In my view, I think part of the problem, a very obvious part of the problem, is that the whole system is plagued of debt, right? And I think this is basically a function of our debt-based currency system, because we are actually we have to go deeper and deeper into debt because this whole system is built on debt, and we have this results in these exponential curves of currency supply and also of debt mounting higher and higher. So I mean, at the end of the 70s, I think what did happen through to the fact that the gold price actually increased that much. This was kind of a recapitalization of the system. I would see it like that, at least to some extent. So I mean, my question to you would be: do you think that there's a revaluation, a significant revaluation of the gold price could kind of recapitalize the system, starting from central bank balance sheets? Because at the end of the day, in my view at least, the real equity of a central bank balance sheet is gold, right? So and since this gold position in relative term to the debt positions has shrunk significantly, it would be able to basically recapitalize a central bank, but at the end of the day, actually the whole economy, if this gold position would increase significantly. So what are your views on this thought?
Well, undoubtedly that is right. And I think that's the end solution, because what we're likely to see is a speeding up of the falling purchasing power of currencies. At the moment, they're sitting on the price of gold. They sit on it because it's a rival, if you like, to this sort of fiat paradigm. But when fiat currency really does begin to fail, there will come a point where central bankers' own pay will need to be secured, if you like. So will the politicians' pay need to be secured. At that stage, the last resort will be to come up with some sort of gold standard. Now, I think the real question is, how long will it take till we get to that point? My view is that it will actually happen quite rapidly from here. And the reasons this is the case is that already major central banks are running into enormous financial difficulties on their own books, because they have taken on board massive amounts of government debt, principally. And if you look at Japan, it's not just government debt, but it's also corporate bonds, and it's also equity ETFs. I mean, basically, they have done what a central bank shouldn't do. They've just, their balance sheet is like sort of 80–90% is bonds now, rather than, you know, if you like, the counterparty to currency issue, which is really what a central bank should do. So what happens as we see those rising yields? Well, obviously, all these central banks go into negative equity, and they are already there. And what's interesting is that as we speak, we see the yen in effect, and it appears to be in the early stages of a collapse. I mean, you know, in the last sort of, I don't know, 4 or 5 weeks, it's gone from 115 to the dollar. And I think this morning we're looking at what, 121, 122, something like that. I mean, it really is a very serious fall in the purchasing power of that currency. And this, to my mind, reflects the overall financial situation and the fact that the Japanese central bank is in negative equity. Now, these things can be resolved, but the worst time to resolve a central bank in negative equity is when there is a financial crisis developing. And that's roughly the combination that I see. And, you know, also the thing about the Japanese economy is if you look at the balance sheets of the commercial banks, and particularly the GSIBs, the global systemically important banks, they're all got asset to equity ratios of over 20. I mean, this is very, very rich. And it's a situation that's been encouraged by zero and negative interest rates. And guess what? I'm sorry to say it, but Austria is very much involved, if you like, in the other real weakness, which is the euro system. I mean, the euro system is potentially worse because there you've got the ECB is now hugely in negative equity itself, and is all its shareholders, who are the national central banks, they're all in negative equity as well, with a few very, very minor exceptions. And their banking system, if you look at the Eurozone GSIBs, there again, you have got leverage assets to equity of well over 20 times. this is, how are you going to resolve this situation when we see rising interest rates, when we see the ECB being forced to raise its deposit rate above the zero bound? I mean, this is going to happen. This is a real crisis. And I think that the other problem with the Eurozone is that the Euro's only really been around for just over 20 years. I mean, it hasn't got, if you like, that sort of genesis that goes all the way back into, there was a time when it was gold. So we have got potential collapses. And to get back to your point about the role of gold, at some stage, unfortunately, you've got, the French central bank, you've got the Italian central bank, the German central bank, and so on. They have actually got significant holdings of physical gold, or at least we're told they have, because quite a lot of it might be leased out. And this is a very serious issue because, when the fiat system falls out, we will find out who actually has the gold, because they're going to have to back their currencies with gold. And in the case of the euro, I think we're probably going back to the Deutschmark and maybe one or two other currencies. And the second currencies will fail, I can tell you that, because the amount of trust. I mean, I know that the Italians have got, the Italian central bank has got a lot of gold, they say. But can you imagine going back to the Italian lira, how much respect that would have? I mean, they can deal with it, but they would have to have a proper gold coin standard in order to make it stick. So I think what we're likely to see is, yes, gold will come back to underwrite the whole of the monetary system by being, if you like, exchangeable for paper. It will have to be. And it's not just a question of doing what Germany did in 1923 with Helmut Schacht, sort of say, well, we're going to introduce a new standard, but not actually make it convertible into anything. This has got to be real this time in order for it to stick. And of course, the other side of it is government's going to have to stop spending all this money on welfare and, fancy projects and all the rest of it. They're going to have to cut right back. It's not going to be an easy transition from this Keynesian world back into a world, the real world, where it's the economy, the productive side of the economy that matters, and government should be as small as possible. There is a lot going to have to happen to get back to a situation really where gold as backing for a currency, turning a currency into a gold substitute, lots got to happen before that's going to work.
Well, Alasdair, I mean, so many thoughts to pick up from your answer. I think it's what's really fascinating is the fact that central bankers seem to believe that now with making small rate hikes, that they will get the inflation problem under control again. And I think it's if we look back, for example, to the hiking cycle from 2004 2006, actually the Federal Reserve did 17 rate hikes, but inflation actually only peaked 1 year after. And I think it's interesting that it seems that central bankers still kind of believe that they have got everything under control, while the market is already telling us, well, this doesn't go so well. However, basically everybody is still blaming the energy shock and saying, well, this is mainly responsible for rising inflation. However, if you look at headline inflation and core inflation, it's actually the differential is quite low. So it's not only energy and food that is rising; it's much more broader. Now, last year in our report, we wrote at length why we're seeing this monetary climate change, so that this pendulum is now really swinging into the direction of rising inflation. And there's actually quite a number of factors. For example, this move from monetary to fiscal dominance. We're seeing that central bankers now seem to have new mandates, like, for example, saving our planet and climate change and dealing with inequality. And then I think the the price, the wage price spiral is now really starting to spin. Now, many people say, well, unions aren't that strong anymore. They're not that important anymore. However, we see that that expectations for rising wages over here is between 5 to 7%, so quite significant. So how do you see the wage price spiral as a driver for inflation, and what other inflationary drivers do you see that the mainstream is missing at the moment?
I think the thing that the mainstream is missing more than anything else is the increase in the amount of money and credit, or currency and credit in the economy. That is the root cause of it all. I mean, prices of some things will always go up, but in a zero monetary growth economy, those rises basically mean that spending is taken away from other things. So if they stop printing money, then the oil price rise, I mean, it would obviously have an effect, but it wouldn't be financed by monetary printing. I mean, that's the underlying cause. And when it comes to wage rises, if you don't increase the amount of credit in the economy, then basically businesses paying those wages have to take a decision. Can we afford this or can we not? And if we can't afford it, then we'll just have to lay people off or whatever. And that would be the ultimate control over what we call inflation. Inflation isn't rising prices. Inflation is actually the expansion of the quantity of money. And the thing that I think is amazing is that the FOMC, which stands for the Federal Open Markets Committee, never mentions the quantity of money in its deliberations. It's always talking about, prices rising here, or, temporary rises there, or supply chain problems, or all the rest of it. And these are the things which obviously only get picked up by the people who are licensed by the establishment to manage money and to run banking licenses. They just literally follow this meme the whole way through. And the result is that the underlying cause of this is completely neglected. I mean, it is always the increase in the quantity of money and credit. Now, I don't subscribe to the monetarist theory, if you like, on the basis that it is not the only thing that drives the purchasing power of a currency. The other thing, which is actually desperately important, is how the public rate that currency. Now, I'll give you an extreme example. If the public decide that, irrespective of any change in the quantity of currency, that they don't want to use it for transactions, then rather like the Russians now find about their dollars and the euros in their reserves, they're completely worthless. I mean, so the public perception of the purchasing power of a currency, or its use value as a medium of exchange, actually is the other factor which monetarists miss. And monetarists is interesting because monetarists actually tend to be inflationists as well. I mean, we saw this with Milton Friedman. I remember the things he was saying about how to deal with the inflation of prices. Well, you index everything, he said at one stage. And I think that was in the mid-70s. And you had this sort of move out from, people were basically all Keynesian, and then they suddenly realized that that didn't work, so they became monetarists. But actually, they were still inflationists. And there was an interesting point, which, and you find the clip on YouTube somewhere, but Milton Friedman was meeting with Ludwig von Mises at one of the Mont Pelerin things. He said, I can't remember the context, but von Mises refused to talk to him. And I think, the point that was missed by Milton Friedman is that von Mises obviously took the view, and I think he's right, that Friedman was an inflationist. And that was the one thing that, particularly in an experience in Austria going back to 21, 22, that was the one thing which Ludwig von Mises focused on as being the evil sin of government, if you like. And the thing that fluctuations in the quantity of money and credit, which was which created the Austrian business cycle. In other words, the sort of periodic, boom and bust that we see. And this periodic boom and bust is a very human thing. I mean, it's bankers sort of getting more encouraged by the initial stimulation of an economy, which comes from, the central bank may be sort of reducing interest rates, encouraging people to borrow. Eventually, it sort of builds up, and then you get to a situation where, perhaps a bank has a leverage of, say, 10 or 12 times asset to equity. Remember what I was saying about over 20 times in Japan, and and in the Eurozone. So you can see how this, it's a cycle of events, and it's going to, that's the next one which they're going to have to try and save us from. So the whole situation, I think, in terms of understanding inflation is completely misread. And I look at it the other way. If Jay Powell was actually to stand up and say, the real problem we have is not supply chains, it's not energy prices, but it is the excessive production of currency and credit. And that is the situation we've got to deal with. I mean, that would be shock horror. Can you just imagine what would happen if he spoke the truth? Now, I don't know how much he believes in money being the driver, if you like, of the price currency, the price relationship. I'm sure he believes a lot more than he's letting on. But the one thing he cannot say is the truth, because it would destabilize the whole economic system.
Fascinating. Perhaps going back to the comparison between the 70s, the stagflation from the 70s and the current situation. I mean, one of the similarities I would argue is, and we wrote that also in last year's report, the new ice age between East and West. So in the 70s, we were in the midst of the Cold War, obviously. And unfortunately, it seems we are back there, some parts, unfortunately, even hot war. So I think this is also from a geopolitical standpoint, very interesting and very relevant also to the global architecture of the currency system or the financial system. So, and what are your thoughts in that regard? I mean, I'm obviously alluding to de-dollarisation, and especially, I think, what was really a key event, the freezing of assets from Russia, obviously. What do you think will be the effects in this regard?
Obviously, it's a very dynamic situation. I mean, but between me commenting and this actually coming out, you never know, it might have all changed. But I think the underlying problem is that Ukraine is a proxy war. That's the first thing. The real the real enemies in this are, on the one side, Russia, on the other side, NATO, and particularly the domination of NATO by America. This is essentially the continuation of a financial war by other means. And I think that's the way to look at it. The sanctions that have been imposed on Russia are undoubtedly going to cause great pain for the West. And we're seeing this with oil prices. I mean, as we speak, I think I can see that US oil is $109.50 per barrel. And that's up recently from what, sort of 60, 70, something like that. I mean, this is a very serious impact. There are other things happening as well. I mean, interestingly, China seems to be backing off a little bit from its partnership with Russia. And that's being put about, if you like, by the people who interpret this, that China is worried that there may be sanctions extended to Chinese companies. So Sinopec, for example, has stopped or put a temporary hold on a joint project, a refinery project with Russia. But I think that's, this is another aspect, because we're talking about a huge, great global financial war. And if you look at it in that context, the Chinese economy itself is now beginning to struggle. It's a different sort of struggle from what we're seeing in the West. I think what we're seeing in China is actually similar to the situation at the end of the 1920s and into the early 30s. You have got a property bust, which is slowly coming through. The result of that, I think, is that international money is tending to leave China rather than continue to go into China. So China, I think, is worried about capital flows, maybe going out of China, rather than worried about sanctions, if you like, in the direct sense. So you can see that this is a very complex situation, and there are a number of ways in which it can evolve. And my view at the moment is that the way it is evolving is that it will make Putin more desperate. I don't think you're going to see a regime change tomorrow, as Biden might hope. You're going to have a leader who's going to get more and more desperate. The one thing he cannot do is back down, because to back down is to admit defeat. I think this is the point about his change of policy over Ukraine. Apparently, he's now no longer focused on taking over the whole country, but taking over the sea, the borderline of the Sea of Azov, and joining up Korea with Donetsk, and the Crimea with Donetsk, and so on. So, a lot less ambition, and he can then call an end to the special operation, if you like. That I think is the way in which he's playing. But we're not going to stop putting pressure on him by saying, well, well done, we've achieved our objective. We're going to back off and remove the sanctions on, central bank reserves and, people who are not directly related with President Putin, but might be, and so on. So I just don't see how, at the moment, we're going to back off quickly, even if Putin achieves his new objective. So this is the situation which I think is just, I'm afraid, just going to get worse and worse. And I can see that a more desperate Putin will not only insist that the protagonists in the West pay for their oil with rubles, which, if you like, echoes the Kissinger-Nixon agreement with the Saudis, which created the petrodollar in 1973. But also, of course, the question now is gold, because it's been rumored that, or at least I think there was a statement from the chairman of one of the subcommittees in Parliament, in the Russian Parliament, that they would accept gold as payment. I'm sure they would accept gold. But this is something which can be intensified. And remember that at current prices, Russia can discount its oil to India, China, whoever else wants to take it, even down to below $60 a barrel, and still profit. So the idea that the Russian economy is under pressure, I think, is actually wrong. Yes, I mean, obviously it is under pressure, but the sort of pressure to destabilize it, I don't think so. It's actually, I think, a lot stronger than the West generally thinks. And remember, the West got the Soviet Union economy completely wrong before the Berlin Wall fell. I mean, all the intelligence was that the Soviet economy was strong. I mean, so their economic advice behind their intelligence is, and always has been, rubbish. So we've got a situation, I think, Mark, which I'm afraid is going to get worse before there's any chance of it getting better. In terms of supply of commodities and the financial situation. And this, to me, always has been a financial war. It is now turned into a financial and commodity war. And we're not going to walk away from this winning. I mean, it's going to be a Pyrrhic victory. It's going to be, if we're lucky, we will win in the sense that we're the last one standing, but that's about it. And this is not good. And it's not good when you've got back channels between America and Russia, America and maybe Germany and the UK not working. In other words, the chance of this escalating into something completely out of control in the military sense, I think should not be dismissed.
I agree, Alasdair, and it's a frightening situation when your kids ask you if there's a third world war gonna start soon. And I think you recently tweeted out that Russia's debt to GDP is just under 25%, which is the lowest for the OECD countries. I think the average there is above 110% debt to GDP. But what I would like to ask you is, we saw that basically with a stroke of a pen, the West took the Russian FX reserves and made them completely worthless.
Yeah.
630 billion. Isn't that basically the strongest case for gold for every central bank on the globe that has ever been made? I mean, I think if you're somewhat critical of the United States, and if you want to avoid as a central banker counterparty risk, then obviously there's only very few choices left, and I think the primary choice obviously is probably gold.
Yeah, I would agree with that entirely. And the situation is even more alarming than just the statement that you have made, because the point about gold is that it's nobody's liability. And you can always use it as money. I mean, the fact that we don't use it as money is because we value money more than we value currency. And we probably value currency more than we value a bank deposit account. So, you know, in terms of the hierarchy, gold is right up there, and make no mistake about it. Not only that, but legally, that is the situation as well. And this is a point people miss. You know, the thing about gold is that you can exchange it, you can use it as money, and money escapes the, if you like, the criminal recovery process that you have, say, with any other asset. I mean, you know, if I was to steal a painting off you, then I have committed a crime. If I pass that on to someone else, and that someone else doesn't know it's stolen, you can recover it off that someone else. No compensation required. That is what the law says, and it's common more or less throughout the world. But when it comes to money or currency, if I steal gold coin off you, and I then go and spend it somewhere, and the person who takes that money takes it in good faith, not realizing that it had been stolen, he can pass it on, and you can't recover it. Gold still has that fundamental difference, which nothing else has. Not even CBDCs, not even you know, cryptocurrencies, and so on. So we're talking about the top, if you like, the real top asset. And this has been brought out very, very clearly by the West's actions against Russia. And I would go further than you suggested, and that is that imagine that you're a central bank, you might even be the Austrian central bank, and you sort of think, hold on, I have got X tons stored with the Fed, I got X tons stored with the Bank of England. I think I better get that back under my control, because look what they've done. You know, they're now anything. I don't know whether Russia's got any gold in terms of market liquidity in the Bank of England vaults. We're not given that information, but if they have, then basically that's been frozen. So every central banker will be saying, you know, really, we need to get our gold back under our control. And even if they haven't got storage facilities, they're going to start building them damn quickly. So this, I think, was a major move, and I think will turn out to be a major mistake by the West. I mean, going back to the Second World War, the Bank of International Settlements still operated as a bank as far as the Nazis were concerned. It took a neutral position, as indeed Switzerland did. So, but now, you know, none of the central banks which store earmarked gold on behalf of other central banks are now taking that position. And it started with the Bank of England with Venezuelan gold. I mean, we were told by the Americans, don't give Venezuela back its gold. So what did the Bank of England do? It rolled over and said, right, we're not giving the Venezuelans its gold. I mean, this is not the role of a custodian. And we're seeing these fundamental changes, which I think have got unintended consequences way down the line. And there is another thing, Ronnie, too, and that is there was an analyst called Frank Venerosa who gave a speech in Lima back in 2002 concerning gold leases from the central banks. And he concluded in that speech that central banks had probably leased out between 10,000 and 15,000 tons of gold, or was it 14,000, I think was the exact figure, which, was had become the ornamentation of Indian ladies, and it wasn't going to get back. Now, at that time, I mean, 15,000 tons was roughly half world total central bank gold reserves. I mean, I don't know what it is. I don't know what's happened today. I would hope that the situation hasn't deteriorated, but you can be sure that there is a lot of gold out there on lease. Now, assuming not even that that gold has gone forever, but if it comes back, I don't think central banks are going to be releasing that gold. So, there's going to be a tightness in the market, which is going to do a lot of damage for fiat currencies. And I think, there's an old saying that the market always wins. And I think that's what we're going to see.
That's so fascinating, and I think there's a lot of agreement upon Ronnie and myself with you. Just for some kind of a context, when we think about this kind of revaluation, which then probably will have to happen to some extent, either be forced upon by the market, as you just said, or perhaps even kind of in a legislated way, but what do you think would be some kind of a price level that perhaps would then be have to be achieved so that the system could keep on working?
I never give price targets, and for a start, experience has told me that I never get it right. So that's the first thing. The second thing is that I think looking at it that way is actually looking at it from the wrong end of the telescope. Really, what we're talking about is not the gold price rising, but the purchasing power of currencies falling. So really, your question is, or should be, if I may venture to suggest, how far down do you see currencies' purchasing power collapsing? And I can see that without action, they will become completely valueless. So coming back to your the way you phrase the question, that means an infinite price of gold, being the reciprocal of valuelessness in a paper currency. But I don't think it's going to quite get there because, as I said earlier, I think that nations will be forced to back their currencies with gold, and it'll have to be done credibly. And the only way to do it credibly is to reintroduce, if they haven't got it at the moment, gold coin, and make that exchangeable for currency notes at the central bank. So, if you have a stash of Austrian shillings, say, under a new currency arrangement rather than euros, you can take it to the central bank and you can say, I have got 100,000 shillings or whatever the figure is. I want a gold coin, or I want coins in return for it. And the central bank be obliged to supply those coins to you. So, that I think is the end point. And where that happens, I don't know. It's a pain threshold problem, I think. It comes to the point where the Keynesians throw in the towel. Let's put it that way. On the one hand, you've got the Keynesians who are saying, oh, this is impossible to understand. We don't understand it. This is completely wrong. Stimulate more, whatever they come up with. And you'll have the politicians and the central bankers who are in the practical situation of finding that their currency is disappearing down the plug hole, becoming worthless. How do we stabilize it? I know that we've turned our back in gold since 1971, or at least the Americans have forced us to do so. The only way we can stabilize this is to return to gold. And whether that's with gold, say, at $100,000 an ounce, $250,000 an ounce, $10,000 an ounce, I honestly don't know. But I think it's going to be further down the rabbit hole than we would think possible at this moment.
I could imagine. I mean, I actually stated that on Twitter a few weeks ago that actually, again, getting back to Russia, that would be perhaps one kind of solution for their problem. When they have the gold, they are in the desperate situation of having already got very, very high inflation. And that was actually my thought as well. They probably, if they really would consider such a thing, would have to go to some kind of real circulation of gold. And as I said, they could do it, and they could also probably politically. I mean, I'm not an expert on that, but they would have to somehow, I guess, opt out of the IMF, right? Because the IMF currently is forbidding you to do such a thing. But that at this stage, I mean, why shouldn't they do that also? I mean, they've basically or they've been pushed out of every international organization I can think of. Why shouldn't they leave the IMF? I don't know if that's a realistic option. Any thoughts on that?
Yeah, I agree with you entirely. And I would go slightly further and say that my information, I can't verify this, is that actually Russia has got a lot more gold than it declares in its reserves. And as one of the major gold producers in the world, I mean, for that statement shouldn't be too surprising, let's put it that way. And also we have seen that President Putin is a gold bug, if I can put it in those terms, or appears to be. So yeah, I mean, that's certainly possible, but the problem is you have to get over the overwhelming global establishment consensus. And that is that the way to manage an economy is to have the flexibility to be able to increase the amount of currency and credit in the economy as the primary means of managing the economy. Now, if you're going to go down a gold standard route, then effectively you're turning your back on that. And you're saying, you know, the economy is not the government's affair. It's the private sector's affair. And we should, as much as possible, ensure that we don't intervene. So we're talking about a change, if you like, in the way in which government views you know, its own economy. But let us accept that the change is accepted in Russia. Then they've got the economy, which makes this eminently possible. I mean, as Ronnie said earlier, the level of government debt is, I understand it's closer to 20% than 25%. So, you know, you've got a government which has got very little debt. As well as that, the rate of income tax is a flat tax at 13%. They don't have the respect for property rights that I would like to see, but, you know, that could be dealt with. This is an environment actually where they can quite easily introduce a working gold coin standard, not just on the back of the existing reserves, but on the back of more reserves which they could declare. And that actually could be the next stage. At some stage, I think Russia might drop a bombshell on us and say, do you know what? It's not 2,000 tons we've got, 5,000 tons, or whatever the figure is. So, yeah, I mean, it would work. You and I know it would work because we're not die-hard Keynesians. But the die-hard Keynesians who run the world have a problem. And so, incidentally, do the monetarists, because the monetarists are inflationists, as von Mises realized, you know, when he spoke to Milton Friedman at the Montpellier Society way back whenever it was. I think it was in the late 60s, early 70s.
Well, Alasdair, you wrote a brilliant piece about CBDCs, and I think you laid out in your previous replies what our solution would be. However, the powers that be, I think they couldn't care less about our opinions, and
True.
From their point of view, CBDCs are the way to go. And you wrote, I will quote it in a report recently in an article. It was called "Designing a New Currency is Impractical." You wrote, "No one could be more ill-equipped to design a new currency than planners employed by governments." I thought it was really spot on. But it seems that if you read the publications coming out from the most important central banks and also from the Bank for International Settlements, it seems that CBDCs are really the next stage and the next solution to the problems that we are facing. And the BIS general manager, Augustin Carstens, he said, "The central bank will have absolute control on the rules and regulations that will determine the use of that expression of central bank liability, so basically cash, and we will have the technology to enforce that. Those two issues are extremely important and is a huge difference to what cash is. So, I mean, it's a very dystopian thing, the introduction of CBDCs and how they can be used for. But wouldn't you agree that this is kind of the master plan going forward?
Yeah, I mean, I would say one thing about Augustin Carstens, and that is I would give him marks for being honest, but he is completely ignorant of the consequences of the introduction of what the Bank of International Settlements is centralizing. That is, how do we design these things and how can we use them? What are the benefits? Not to you and me, but to the central banks, the issuers. It's always that way. So it is completely dystopian. I don't think it's going to happen. For a start, well, the two things. It's going to take some time to introduce a CBDC because the bureaucracy in government, in a central bank, and all the rest of it means this has got to be tested, it's got to be trialed, it's got to, and then you've got to take out legislation. I mean, you've got to go to your parliament and you have got to get laws passed that make this currency, if you like, legal currency. And I think that at that point, you're going to have problems. Think in America, who actually pays for the politicians' electioneering expenses? It is the banks. I mean, more than anything else, I mean, industry chips in as well, obviously, but more than anything else, you look at the political contributions that come out of, JP Morgan, Goldman Sachs, Citibank, Bank of America, all, they're funding the whole of the political situation. Now, if you think that you can get a system in place, a currency system in place that's going to cut out the whole of the commercial banking network, which is effectively what is being proposed, and you're going to get the politicians being bought for by the commercial banking sector actually supporting this, I think you're an enormous optimist about the power, if you like, of central government to come up with these plans. So I think it'll fail at that point, if nothing else. Yeah. And of course, we've got the other thing, and that is one of the points I was making in that article, and I think particularly in the case of CBDCs, they are not for criminal purposes money. It's a completely different situation. So what this means is that if you get paid by someone in a CBDC currency, you cannot be sure that that money can't be taken off you as the proceeds of crime, as tax evasion, or whatever it is, because currency is officially removed, if you like, from that criminal penalty. So you can take ordinary currency, you can take euros or whatever, knowing that it doesn't matter who's had them before, you then possess those currency notes. That's not going to be the same with the CBDC. So that is the legal situation. So it's a big legal minefield here. I'm not saying it can't be dealt with, but it's a big legal minefield. So I would be very, very surprised if they ever get to first base with this. And not only that, but the problems we face now are now. They're not in 2 or 3 years down the road. The idea, and the fascinating thing is that everybody's beginning to talk about a reset. I mean, they realize that the situation isn't working, but their plans are sort of, by 2030. Come on, we got the problem now. So this is, I think that's my answer really to this whole CBDC thing. And there's another aspect. Last time this was really tried was in revolutionary France. They had the assignat, which they destroyed by over-issuing. And then they came up with this wonderful idea. Oh, right. Territorio mandat. This is a new currency which will replace the failed one. And what happened? Within 6 months, that was valueless as well.
Yeah.
So governments doing this, forget it. It's not going to work.
Yeah.
And it's not going to happen.
Yeah, I just wanted to add a similar thought, because the one thing which you also need to introduce in your currency is trust. Yep. And trying to introduce basically a digital currency, which a large part of the public, I think, would be prone to be very suspicious in the first place, during, or perhaps at the peak, we don't know, at the of an inflationary cycle. So I don't know how that will go down if people are basically forced to use something completely digital while you already have inflation rates which are super high, and then people probably will have become much more critical towards the currency system in a few years' time, if, as we probably expect, inflation stays here or even increases. I think it will be a very, very difficult sell to the public now to switch in this kind of digital system. So on this kind of thought, I'm optimistic that they probably will have a difficult time to introducing this.
Yes, I agree. Trust is the central focus on this, and that is that as long as you have pure fiat currencies, they rely on trust. And the whole point about gold is that you don't have to trust the government. The only bit that you really need to trust is that the government has sufficient gold to meet its currency liabilities. And it doesn't mean total currency liabilities. It means the liabilities that that under, I mean, we call them stress tests now, but under maximum stress, a government can still continue to supply gold against paper currency at the fixed rate. And this is very, very important. So we need to do away with this trust factor in order to have a stable currency. Yeah.
Alasdair, briefly talking about Bitcoin. I know that it's a quite emotional discussion most of the times, and you recently tweeted out that Russia's use of Bitcoin as a means of basically avoiding sanctions could cause other governments to regulate Bitcoin out of practical existence. I know that you're not the biggest supporter of Bitcoin, which is totally fine. But wouldn't you say, compared to fiat currency, it's still much better, and that it's some sort of a that Satoshi Nakamoto, whoever it was, completely understood our monetary system and why gold was chosen?
Well, I think he partly understood the monetary system. He partly understood it in the sense that he could see that central bank, and we assume this because we don't know, but we assume that he could see that central banks could issue currency in infinite quantities. So if he took an equivalent or devised an equivalent which had a fixed limit on it, then obviously the value of it would rise. And I mean, there are lots of brilliant things about Bitcoin. I mean, the blockchain and all the rest of it, and the fact that it has spawned, I think, over 10,000 other cryptocurrencies now. The whole concept has really taken off. But I would say that the great benefit of gold is it is flexible. It is flexible insofar as we have various uses for gold. Most of us have sort of, some items of jewelry, like gold watch, or particularly in India, the women wear their gold wealth upon themselves. So probably slightly more than half the total gold in the world is actually non-monetary in that sense. So if there is demand for more monetary gold, there is a source there which can move into it. I think this is very, very important. The other thing is that the quantity of above ground gold stocks increases more or less at the same rate as the global population. So as a stable form of money, it does make sense. And it's a stable form of money upon which credit is expanded as well. So the system works. What it means is that if you are planning, say, to make a new motor car, let's say, something like that, this is something which probably takes 10 years of the planning, right? You've got to fund it, you've got to finance it. Or if you've got the same money yourself, you'll probably say, well, what's the return going to be on my money compared with what I might get elsewhere? Now, if you're going to fund the building of a factory, all those upfront costs and all the rest of it, you're going to require to borrow money. You're going to get savers' money or your own money and turn it into capital for the project. Now, central to this is the calculation as to what you can sell those motor cars for at the end of the process. Now, with gold, you can take the price of the motor car equivalent today and say that's approximately what it will sell for in 10 years' time, because we know that prices are stable. So what are my costs? I can then work back and work out my costs, and then I know how much profit I'm going to make after I have been able to pay the 3.5% interest or whatever it costs to borrow. Now that is a classic industrial model, if you like, going back before the First World War. Now imagine doing the same in Bitcoin. Do you know what the price of Bitcoin is going to be in 10 years' time? Can you do your economic calculation? No, you can't. And then we've got the other problem, and that is, I come back to this legal problem as far as cryptocurrencies are concerned, and that is that they are not currency for the purpose of criminal law. They are property for the purpose of criminal law, which basically means the authorities can seize your Bitcoin because they were in the past the proceeds of crime or the result of tax evasion or whatever they dream up. So you're not protected. I mean, it basically means that Bitcoin is not and never can be a replacement currency. So we then have the question, what is it? And I think that it's been demonstrated that it more or less performs like an equity. And in a sense, it is a hedge against inflation in the same way that an equity is. The difference is that Bitcoin doesn't pay a dividend, but equally, on the other side, it's not, open to the vagaries, if you like, of economic performance. So, it is, if you like, the ultimate equity. And the problem then is that when you get rising interest rates and it kills the equity market, which is inevitable, then what happens to the price of Bitcoin? I'm afraid it'll tank with equities. So, I can't get enthusiastic for Bitcoin on that basis. I can see that it's been a wonderful machine, and indeed, I have dealt in it, and I have made, a nice little turn. Fine, but there are other aspects under it which I wouldn't be all that keen on, like the use of Tether, for example, to facilitate dealings in Bitcoin. I mean, you don't know that the Tether is actually worth the dollar it says it is on the tin, because you don't know what the underlying assets are. And for all I know, it's kept secret because perhaps Tether is investing in Bitcoin. And then you've got this Ponzi scheme. Now, I don't know that's the case, but I don't know any different. And that is the key point. So you've got three things. You cannot do economic calculation with it. It does not have the same rating in criminal law as currencies, credit, and gold. There is this last thing that it is actually just a glorified equity, and therefore will run an equity market cycle. And that's what it's become. I mean, the holders of it are the same people who are long of wonderful, high-performing technology equities in the American stock market. It seems to me.
I would disagree to some part at least. I think there's many young people, very very ambitious, motivated people that actually, due to Bitcoin, found out about the Austrian School of Economics. Who, due to Bitcoin, started researching the topic of money, how money is created, where money is coming from, and which are asking those very, very important questions that in the traditional financial market space, nobody is actually talking about, and nobody is discussing. So I think this is a very, very positive development. And I know many Bitcoin holders or hodlers that actually completely understand gold and that actually also hold gold. So I think there's still many similarities. But
yeah, I don't disagree with that. And I mean, this is actually a very important point, because there's the old saying that not one man in a million understands money. You know, Bitcoin has changed that somewhat. And I think that's very, very important to realize that there are knock-on effects from that. I mean, this is separate from Bitcoin or whatever your favorite cryptocurrency may or may not be. You're absolutely right. It has awakened people to what central banks are doing with currency, but it's only a partial recognition of what is going on. And I mean, I think the most important point I find is that it is very difficult. The most difficult thing I find is to persuade people that the, you know, in any price relationship, the money is not as constant as you think. You know, in other words, you've got the objective and you've got the subjective value. You know, I go out and I buy a motor car. I spend, say, £20,000 buying a motor car. The objective value in that is £20,000. The motor car is the price that varies. I negotiate maybe a, you know, a discount if I can, and all the rest of it. The idea that the price is rising and falling because it's the purchasing power of that objective value, which is actually changing. I find it so hard to get over to people. It's stuck in their brains. Yeah. So the understanding, I think, of money that's come from Bitcoin is partial, but nevertheless, I think it is going to have a profound effect on the way trust in paper currencies disappears as the situation that we currently see progresses.
Now, Alasdair, coming to an end, what would your uncle basically say about the current situation that we're in, and what would he suggest being what was his solution be as a politician? I don't know if he knew about the Austrian School of Economics and how close your relationship was, but what would he say about it?
Well, very difficult one to answer. I think at that time, in the Conservative Party, there was a greater understanding of the fact that an economy would progress rather than grow, and you had to leave the economy alone to allow it to grow. In other words, government intervention was counterproductive. For any politician, however, that was not the reality you were dealing with. You were under demand the whole time to intervene this way, that way, the other thing. He basically was not an interventionist. I think I would say that. Whether he was aware of Austrian economics, I would think he wasn't aware of it at all, but he was probably more aware of economics in the classical mold, if you like. As indeed we all were. I mean, you know, I found when I went into the city in 1970 that the economics that the Bank of England and the Treasury was chucking out in terms of its announcements and so on, it was bizarre. You know, I just didn't understand it. And who is right and who is wrong? I believe I'm still right. But, you know, I can argue the case, whereas they can't. I mean, I find that, you know, talking to senior journalists, for example, in the UK, writing for prestigious newspapers on economics, I end up disagreeing with them. And they, you know, you get a sort of email debate that goes backwards and forwards, and it always ends the same way. I don't believe you're right. You know, in other words, it comes down to belief as far as they're concerned. They believe in the Keynesian system. And I think that is the one thing that's happened since the 60s and 70s, because Ian died in 1970. You know, from that time, I think, you know, the Conservative Party has become a lot more sort of macroeconomic, you know, relying on statistics and all the rest of it, which, of course, Ludwig von Mises clearly demonstrated was not the way to understand economics. It was effectively, he used it as a title of his book, Human Action. You can't quantify human action.
I just found a great quote by Mises regarding the wishful thinking around unlimited government largesse, and he called it the Santa Claus principle. I don't know if you're aware of that. And he said, An essential point in the social philosophy of interventionism is the existence of the inexhaustible fund, which can be squeezed forever. The whole system of interventionism collapses when this fountain is drained off. The Santa Claus principle liquidates itself. I think
Yeah.
that's a very good summary, basically, about the discussion that we just had. Mark, is there anything else that you want to ask Alasdair?
A lot, but I think it's a really nice closing quote which you found, and I want to say thank you very much, Alasdair, for joining us. It was a great pleasure, and looking forward to keeping in touch and following your great research on gold money.
Well, Mark, the pleasure is all mine. Thank you for having me on.
Alasdair, thank you very much from my side as well. I hope that we can break bread in Vienna or wherever soon again and talk about all the things that are going on. I really appreciate taking the time. Thank you very much for the great work that you're doing. Every week you're you're putting out fantastic articles. So thank you very much and all the best, my friend. Thank you.
That's very much my pleasure, Ronnie. Nice
Thank
speaking to you again.
Bye-bye.
Bye.